It's the ultimate dream sold to every aspiring property investor. Buy off the plan, lock in today's price for tomorrow's market, secure massive depreciation tax benefits, and enjoy a completely maintenance-free asset. It smells like fresh paint and financial freedom. But what if I told you that fresh paint is actually the scent of burning cash? Welcome back to PropSpotter, the smarter way home. We help smart investors find the right suburb and property for their goals. Today, we're taking a sledgehammer to one of the biggest myths in real estate. We are talking about new builds. We're talking about the forever home trap, the psychological trick that convinces investors to buy brand new stock that is destined to underperform. Today's video is going to explain exactly why your brand new investment is likely to cost you money compared to the alternatives. We're going to look at a stunning piece of data showing a 72% shift in what buyers actually want. And we'll compare the cold hard numbers of capital growth in high supply apartment markets versus established housing markets like those in Brisbane. Let's be fair. I understand why people buy new builds. I've been tempted myself in the past. The marketing machine behind some of these developers and builders can be incredible. They dangle massive incentives in front of you, stamp duty concessions, rental guarantees for the first 2 years, and of course the big one, the big shiny one that doesn't cost them anything, depreciation. Your accountant would love a new build because they can write off the carpet, the oven, the blinds against your income. It's like free money from the tax man. But there's a deeper psychological hook here, which I call the forever home trap. Even if you're buying purely for investment, a little voice in the back of your head says, if it all goes wrong, at least I could live here one day. It looks nice. It's clean. It's new. Investors often buy properties they would like to live in now, rather than what the broader market will desperately need in 10 years. They buy with emotion, disguised as financial strategy. And the developers and builders know this and they sell it right to your face. But here's a reality check. A brand new apartment or house and land package in a new estate is exactly like a brand new car. The second you turn that key in the front door, poof, there goes your money. Real estate wealth is not built on the house. Houses depreciate, the carpet wears out, the taps leak, the style becomes dated. Real estate wealth is built on the land, ladies and gentlemen. The dirt underneath the structure is the only thing that appreciates in value because they aren't making any more of it. Houses depreciate and land appreciates. When you buy a high density new build or a brand new house in a brand new estate, the land content of your purchase is almost zero. You own airspace and a depreciating asset. The same applies when you buy a new house in a new estate. You have likely less land than the suburb next door, which is also 5 to 10 minutes closer to the city center. So if a shiny new house isn't what holds value, what does? To understand where the market is going right now, we need to look at what actual humans are searching for. There's been a 72% increase in searches for single story on property portals, along with the key term dual income, which I'll cover off in the next video. Why is this specific phrase so important? What does single story tell us about what the market's looking and what the market's psyche is going? It tells us about a fundamental shift in demographics and lifestyle post-pandemic. Firstly, an aging population wants accessibility. They're downsizing from 2-story family homes, but they refuse to move into shoebox apartments. They want land, they just don't want stairs. And secondly, families crave usable space. They want a backyard for the dog and a patch of grass for the kids to play in. You don't get that on the 30th floor, and you sure as hell don't get that in some of the new estates that they're pumping out by the dozens. That 72% statistic is the smoking gun. It proves that demand is aggressively moving towards established, accessible houses on decent-sized blocks of land. Yet, what are developers building record amounts of? High-density units of small houses on less than 250 square meters of land, or 300 apartments stacked on top of each other. Why? Because it's profitable for them to stack 300 apartments on a block of land that used to hold 4 houses, or build 4 houses on a block of land that used to hold 1. The market needs established land and wants lots of it, but investors are being sold new, tiny blocks of land or airspace. This disconnect is where you lose money. Let's move from theory to hard data. Let's look at what's happening right now In a market like Brisbane, Australia, in the last 12 months, house prices in Brisbane have gone up 14.5% in aggregate. In suburbs down south, like Logan Central, Slacks Creek, etc., they've exceeded that 14.5% mark. But why? Because most houses there have a higher than average median land size of greater than 650 square meters, and that land is what is appreciating. It's also come from a lower base, which has made it more affordable, which basically means that people are moving there for lifestyle and reflecting that there is a finite supply of houses in close proximity to the city. You cannot print more land in Paddington or New Farm or Logan or Slacks Creek. Now contrast that with a high density unit market. Yes, these units have seen some growth because of a rental crisis currently going on in Brisbane, but that's been nothing close to what we've seen in established houses. The problem with the new build units is the threat of endless supply. If 500 buyers suddenly want an apartment in a specific suburb, a developer can go knock on the doors, get an approval to build a tower with 600 apartments. The moment supply meets demand, price growth stops dead in its tracks. When you buy an established house in a landlocked suburb, supply is fixed. When demand rises, prices must rise. It's economics 101. Don't be seduced by these 5% rental guarantees on new builds while ignoring the 15% capital growth on the ugly duckling established house down the road. The moral of the story is this. As an investor, you need to stop buying what the glossy brochures are selling and start buying what the market actually values. Scarcity. The forever home trap lures you in with the comfort and tax breaks, but it often leaves you with an asset that struggles to outpace its long-term build. Now, if you think that you want to chat about property, feel free to reach out to PropSpotter and we can get you started on the process and run you through what it's like to get you in an ugly duckling that will appreciate. Chat soon.